All right, sawa. So I want us to begin, and today is commercial transactions. Today is commercial transactions. Somebody confirm you can hear me clearly. I think I'm losing my audio.
Jacktone, we can hear you.
Okay, fine. So today's commercial transactions. And commercial transaction is very simple. It's very easy. It's very direct to the point. And I would want you to understand commercial transactions from a very deep sense. But the good thing about this unit is that it is very practical. It is not theory. There's no theory when it comes to this one. And therefore, you are able to understand the concept very well. So the first thing you need to understand is the concepts, really, is the concept. You have to understand once you understand the concept, that is all you need to have. You don't have to go all the way through case law theory. That can be there, but the most important thing is for you to understand the concept. For instance, if you talk about financing a company, what is the concept around that? What is the concept? What is the deal around that? That is the most important thing that you need to understand. So buckle up and let's see. Now, if you look at your course outline, I'm hoping that I have an updated one. You realize that there are quite around 6, 7, or 8 topics in your course outline. The first one is companies. We have mergers and acquisitions. We have partnerships. We have insolvency. We have the financial services and payment systems. We have the commercial agreements. And then we have the tax and then the MPSR. Okay, so we can start with any. You can start with any that you wish. But for the sake of neutrality, I want us to start from companies. I want us to start from companies, the law of companies. Now, you did business law in high school. Was it high school or campus? Business studies. Sorry, business studies was in high school. So some of you are doing business and some of you are busy doing home science, agriculture. I'll see your life. So for those who did business, you must have been introduced to the concept of companies, corporate law, and partnerships. Okay. Now, in your campus, whichever law school you went to, you might also have interacted with company law, generally, the theories of company law. Now, in KSL, now we're looking at the practical aspect of company. That is the law of companies. Really, what is the law of companies? So there are a few things you need to understand when you deal with the companies. Companies are not complicated, but people really confuse it. There'll be 6 questions in that paper. 4 of them will be from the question of companies. Okay? At least 4 of them will be companies. That one you can take it to the bank and bank it and you'll get interest. There'll be 6 questions and 4 of them will be companies. So there's no way of running away from companies. Okay? And then, of course, you need to understand that even the individual topics, when you talk about insolvency, you're simply talking about companies. Okay? When you talk about mergers and acquisitions, you're talking about companies. Okay? When you talk about payment systems, you're still mentioning something about companies. When you talk about taxations, commercial agreements, so you are still talking about companies, even in that aspect. So there's no way of escaping companies. So companies is part of your life in as far as commercial law is concerned. So the best thing that you want to do to yourself is first understand the law of companies. Just understand generally what is this thing called companies. Okay. Now, the first thing I would mention is that a company is a business vehicle. Okay. A company is a business vehicle. Some of you are businessmen and businesswomen. Okay. Some of you are doing business. What is a business? A business is that activity that generates income for you. That is a business. So we have business vehicles, models of carrying out a business. Number one, you can do a business as a person, just yourself. That is a sole proprietorship. Okay. You can do business as a partnership. You and your partner, you can do business. That is a partnership. You can also do business as a company. You can create a company and then you can have that company doing that. You can have a joint venture. A joint venture is also a part of a business vehicle. You can have a franchise, which is still part of a business vehicle. So a company, just like all the examples that I've mentioned, are business vehicles. They are vehicles for running a business. They are entities for running a business. Are we together? So what makes a company, and what makes a partnership, or what really is the difference, and what informs you to have a company? Okay. Now, there are few concepts that you will need to understand when it comes to company law, even before we start discussing the actual company law. Okay. The first aspect is the principle of separate legal personality. The principle of separate legal personality. What is the meaning of that? Solomon versus Solomon. Okay. What is the meaning of separate legal personality? What is the essence of that? Okay. It is very important for you to understand. Now, remember that the principle of separate legal personality at all times will demand that a company is different from the owners of the company. So if the company is yours, the principle of separate legal personality demands that you are a different person from the company. Okay? So the company is a person and you are a person. So that is separate legal personality. I don't know kama tuko sawa. Tuko sawa?
Tuko sawa.
Sorry. All right, so like I was mentioning, that you should never forget the principle of separate personality, where we are saying that yes, the business is yours, it is your company, but the company is a different person from you. And that is the concept of separate legal personality. And that means that anything that the company will do, it will do it as a company, not as you. It is not an extension of you. Okay? It is not an extension of you. It is the company doing that. That is separate legal personality. Talk about contracts, talk about property, talk about decisions, talk about liability. All those will belong to the company. Why? Because the company has a separate legal personality. That is the first thing you need to understand and internalize it, because it is that will inform even other forms of other principles, like Alder's principle, the principle of liability. All of those are going to come from the principle of separate legal personality. So please understand that. The next thing that you need to understand is the question to do with directorships. That one of the elements, one of the characteristics of a company is that companies will have directors, and every company must have a director. Okay, so what is this whole thing about directorship? Now, every company must have a director. Every public company must have at least 2 directors, and every private company must have at least 1 director. Now, directors are the officers of the company that run the affairs of the company. They run the affairs of the company. Okay, they are officers of the company and they run the affairs of the company. However, their actions are also separate from those of the company. However, there are certain instances where the action of a director may bind the company. Okay, we will talk about that at some point. So we have directors. So companies have directors. There's no company without a director. Okay, So those are directors. So we have two types of directors. We have executive directors, those are employees of the company, and then we have director shareholders who are owners of the company. So when you create a company, you make yourself a director versus when you hire someone to be a director in your company. So the person that is hired by the company to be a director, that is an executive director. Okay, they are employees. Now, the other thing you need to understand is the question of shares. Shares. Now, why is the question of shares important when it comes to companies? Because we have said that the principle of separate legal personality demands that a company is just a company on its own. It's a separate legal person. So when you create a company as Brenda, for instance, you have you as Brenda as a person, but outside you, there is a company. Okay? Now, share is the unit of ownership in that company. So you will have to own a share in the business for you to be part of that company. So the only way you can become part of a company is by owning shares in that company. And how do you own shares in the company? You buy the shares in the company, or unless those are allotted to you. We'll talk about that also. But understand the concept of shares, that this is a unit of ownership. It is the shares that will give you ownership in the business. When you buy a portion of the company, that is a share. Like I've said, you have a loaf of bread that has 16 or 12 slices. Now, each slice is a share. So the more number of shares slices you have, the higher number of shares you get. So those are shares. Shares. Are you together? We'll talk about shares a little bit later. And then we have resolutions. Again, you need to understand what are resolutions. Now, resolutions are decisions of a company. Now, you have decided to join this class. That is a resolution. You decided to go to work. That is a resolution. Somebody mute your microphone. Mute your microphone. Okay. The easiest way is, yes, thank you. So I'm saying you decided to join this class. That is a resolution. You decided to go to town and eat. That is a resolution. You decided to buy yourself a new pair of shoes. That is a resolution. So what are resolutions? Resolutions are decisions of a company. Now remember, a company is a person. A company is a person. So the same way you can decide to do something as Caroline is the same way a company can decide to do something. Now for you, it is a decision. For a company, it's a resolution. So all the same thing. So resolutions are just decisions of a company. So companies, all companies operate by way of a resolution because companies cannot speak. Therefore, resolutions must be passed for everything in the company. Whether you want to make tea, buy coffee, whether you want to build or sell or borrow money, there must be a resolution. The company must decide. Why is the company deciding? Because we have said the principle of separate legal personality demands that the company should be a person on its own. And therefore, the company will make a decision through a resolution. So you need to understand resolutions very well. The next thing that you need to understand is the question of membership and shareholding. Now we have a company, we have members of the company, and then we have the shareholders. What is the difference between a member and a shareholder? Of course, you understand that all members are shareholders, but not all shareholders are members. All members are shareholders. For you to become a member of a company, you must do two things. There are two things that will make you a member of a company. The first thing is that you have to buy shares in that company. Number two, you must sign the memorandum of association of the business. So the memorandum of association and the shares will make you a member of the company. However, if you want to become a shareholder in the business, you don't have to be a member. You don't have to sign the memorandum. You just need to buy shares. And buying shares is very easy. Just download the app, create an account, serious account, and then start buying shares. Okay, as low as 4 shillings, 1 shilling, you can be a shareholder in a company. But for you to become a member of a company, you will have to sign the memorandum of association. Now, also, you'll need to understand the ways of becoming a member is through share. You buy the shares. So any person that buys the shares, you become a member, but only after you sign the memorandum. So also understand the question of members and shareholders. These are people that are having shares in the business. So sometimes those words can be used interchangeably, but make sure at the back of your mind you know that not all shareholders are members, but all members are shareholders, because when you sign the memorandum of association, there are three things in that document. The first thing is that we, the subscribers to this memorandum, we have decided, number one, to form the company. Number two, we have decided to be members of the company. Number three, you have decided to buy at least one share in the business. And therefore that makes you what? A member and a shareholder. Okay? So that is membership and shareholding. So when you talk about membership and shareholding also, you need to understand that what are some of the rights of members in a company? Such kind of questions should come to your mind. What are some of the rights of members? As a member of a company, what is my role? What do I do? What is the relationship between me and the company as a member? Okay, we shall talk about that, but I want you to have that concept at the back of your mind. The next thing that you need to understand is the liability. Liability. Now, liability is what is owed. Liability is what is owed by a person to another person. So your liability to me will be the amount of money that you owe me or whatever you owe me. In the context of a company, the liability of a company is what the company owes. So it is two ways: what the company owes and what somebody owes the company. So you can either owe the company as a shareholder, and also you can owe the company as a debtor. Okay, so liability is what you owe the company. Are you liable to pay anything to the company? Now, in that context, you need to understand liability of members, liability of directors, and then the liability of the company to third parties. So, liability of members is limited sometimes to their shares. I'm going to explain that. Sometimes it is limited to the shares, sometimes it's limited to guarantee what the members owe the company. So how do you decide how much you owe the company? So your liability to the company as a member is how much you owe the company. So how then do you decide how much you owe the company? Or how will the company decide how much you owe it? Are we together? That is exactly what we are calling liability. At the same time, you need to understand the liability of directors. What is this? Now, sometimes companies don't have eyes, they don't have hands. So therefore, it is the directors of the company that will be running the company. The directors of the company will be running the company. And therefore, sometimes there are things that the directors of the company will do that will attract liability. Okay, so that is the liability of directors of a company versus the people that they interact with, the people that they transact with. Are we guys together? I want you to understand that point very, very well. I want you to understand that point very well in terms of liability. Understand that point very well. Now we'll discuss the question of liability in a few. In a few, we'll discuss the question of liability. Okay. Up to there, any person getting confused? Anyone getting confused? Put up your hand. Like I've said in this class, there is no Harambe in Kaisar. It is just you, my friend. It is just you and you alone. And things will bite each other. Things do bite each other there. Okay? I mean, thoroughly. So when you walk to that exam room, you will even forget your name. So ask the question right now. so that you understand. My main aim is to make you understand and to have you understand these simple things, and then we proceed from a point of information and together. So are we together this far? Are we together so far? So far, so good. We good.
Yes.
Okay. Sawa. Now, the other thing you need to understand is the concept of funding companies. Now, a company is not your thing. A company is not it's not a property. It's not your property. Let me say that. A company is not a property. And based on the fact that a company is not a property, you need to deal with the company professionally, even if the company is yours. Even if you are the only shareholder in the company, you need to deal with the company professionally. And therefore, you need to understand the funding of a business, the funding of a company. Very, very important. How do you fund a company? You fund a company through equity. Equity means you're buying the shares of the company. When you buy the shares of the company and you become a shareholder in the company, that is equity. Equity simply means the buying and selling of shares or stock. Buying and selling of shares, that is equity. And therefore, equity finance is whereby you're financing a company through the buying of shares. So you give the company money, the company gives you shares. So if you look at the NSC, that is the Nairobi Stock Exchange, it is a marketplace for stocks. So you can just go there and find Safaricom shares. Today they're running at 15 shillings. You can say, let me buy 100 or let me buy Safaricom shares worth 10,000. That 10,000 goes to Safaricom, and Safaricom gives you shares. That is equity finance. So when you buy shares, of course, the only motivation why you want to buy shares in a company is because you're expecting dividend or you're just trading, whichever way. So you're expecting that at the end of the year, when Safaricom makes a profit, Safaricom will remember us, the shareholders. How will Safaricom remember you? Through declaration of dividend. Safaricom will declare dividends and simply saying that, hey, we made a profit this year of 200 billion. Now, out of this 200 billion, 100 billion we are going to give out as dividends. So what are we saying? All our shareholders, we want to send them something small. So they are going to say that, hey, for each and every share that you have, each and every Safaricom share that you have, we are going to give you 2 shillings. So if you have 100 shares, okay, if you have 100 shares, then you're going to get your 200 shillings. That is your dividend. So depends on how many shares you have and how much Safaricom is giving us as dividends. So that is equity finance. And then we have now the debt finance. Debt finance is where the company will borrow a loan. The company will go to the bank, or other way, there are a lot of ways. You don't have to go to the bank. There are a lot of ways of getting a loan from anywhere. That is debt finance. So there are only 2 ways of funding a company: debt finance and equity finance. So we will talk about that also. The next thing also you need to understand is the question of third-party relationship with the company. That also is directly linked to the liability discussion. So the questions to do with ultra-vires, the question to do with indoor management rule, the question to do with the constructive notice, all those things. There are discussions to do with the third-party relationship with the company, and also the question of piercing of the corporate veil. Okay, when you remove the corporate veil, when you pierce the corporate veil, then also that forms. We'll discuss that. The next thing you need to understand is conversion of companies. That we have different types of companies, but you can convert one company to the other. And then, of course, you need to understand the concept of execution of documents in a company as well as foreign companies. So that is generally what you expect from this discussion. So aside from that, Michael Okile.
A question about shares. The thing about called up shares and uncalled up shares, and also the concept about whereby a member's liability is limited to the members' unpaid shares. What can you say about that?
Your question is very funny. Your question is very funny. Now, what can I say about that? That is all you want to know. You've not
just-
asked me a question. You've not
Okay.
asked me a question, but I get the point. I get what you're saying. I'm just bantering around. I will talk about that. Like limitation liability is in my next discussion. When it comes to types of companies, we'll look at the limitation of liability. So just stay with me for a minute. Any person? All right. Now the first question I'm going to ask is, what do you think are some of the characteristics of a company? Someone. Characteristics of a company. What do you think are some of the characteristics of a company? Put up your hand. The characteristics of a company. You guys seem to be the only visitors in Jerusalem. You know, that story has been told in the book of Matthew chapter 28. That shortly after the resurrection of Jesus Christ, as he was walking down, he met two disciples. And they were talking about how the Romans, they'd killed Christ, and the bad things did to him. And then Jesus asked them, are you the only visitor in Jerusalem? Or they asked Jesus, are you the only visitor in Jerusalem? So when I'm asking you, what are some of the features of a company, characteristics of a company? I'm expecting 10 hands. Guys, participate. Are you guys shy? You guys are shy. Sawa. So let's start with Omwenga. Omwenga, Ora.
Yes, a company is an artificial person.
That is not a feature of it is a company. It's like saying a man is a human being. Yes, it is. But what are some of the features of
It has a separate legal personality.
It has a separate legal personality. That is one thing that makes a company to stand out. If you list all the business vehicles, that we have, companies, partnerships, and all those, you realize that one of the advantages, one of the features of the company that makes the company to stand out is the separate legal personality. Okay, Lois Mwachi.
A company can own property.
A company can own property in its own name. Okay, a company can own property in its own name. So if you have a company and the company buys land, the company can be registered as the proprietor of that land. Okay, that is that. Mora, Susan.
Yes, there's an issue of perpetual succession.
What is the issue with that?
When, let's say, a member dies, then the company doesn't stop at that point.
So rephrase your answer and answer the question. So can you try rephrasing it?
Upon a member dying, the company continues with business.
No, that is the explanation. What is the point? Make the point and then you can explain.
That's what I can say.
So what is the point?
There's a perpetual succession, as in
Yes,
the company
that is exactly
continues.
what I wanted you to say.
Yeah.
That is exactly what I wanted you to say. So the main point there is that companies have perpetual succession. That is the main point. Okay. And then now the explanation is just the way you said it, that even if all members of the company die, the company will still exist. That is perpetual succession. Thank you so much, Mora. Let's go to Omondi Isaiah.
A company can be
what? You are muted.
sued or sue in its own name.
Yes, a company can sue and be sued in its own name. Yes. Cynthia Mudabe.
A company can enter into contracts.
Company can enter into contracts in its own name again as well. Yes. Someone else? All right. So companies. That is somebody mute. Those are some of the features of a company. They are features of a company. Okay. And these features sometimes they become advantages of a company over other business vehicles. Somebody will tell you, why should I have a company instead of a general partnership? Why should I have a company instead of a sole proprietorship? So it is because of the features that you have mentioned that a company will stand out. Are you together? So those are the features of a company. And then the same features will mutate and become advantages of a company. So if the question is asking you, what are some of the advantages of a company? A company has separate legal personality. A company can own property, can sue and be sued in its own name, can enter into contracts. Those are features of, it has perpetual succession. Those are features of a company and also advantages of a company over other business vehicles. So that is the first thing you need to understand. Features of a company and the advantages of a company over what? Over other forms of business association, business vehicles. All right. Now, let us talk about types of a company. That is the main discussion. Let us talk about the types of a company. Okay. How many types of a company do we have? We have two types of a company. The companies that we have are in twofold. There are two types of a company in twofold. Okay, so we have public companies and then we have private companies. Okay, public companies and private companies. But also the twofold is they could either be limited or unlimited. So that is the twofold. So if you are told to define the type of a business vehicle that you can see in the question, you have to tell us both sides. The first side of the coin is that it is public limited or private unlimited or public unlimited or private limited. So a private limited company, a public limited company. So those are types of a company. Okay. Now, before we get into discussions on limitation and everything else, I want us to talk about the features of public companies, features of private companies, and features of limited and unlimited companies. So let's start with public companies. Public companies. What are some of the features of a public company? What is it that you see that will tell you that this is a public company? Public companies. What are some of the features of a public company that whenever you see them, even in a question, it just rings to your mind that this here is a private company. Weka mikono juu. Okay, let us start with Naluende.
A public company must have a company secretary.
Must have a company secretary. Yes, that's a feature. Yes, I'm looking for the main ones. Yes, it is a feature. Yes, Njiraini, Davis, or David.
Its shares are easily accessible to the public.
No. Don't use those words. When you are answering questions in commercial and anywhere else, Don't be too lazy. Don't just throw words. What do you mean easily accessible? Where did you read that?
It's okay. I'm going to put it in another way. Okay, in the way I understand how I can identify a public company is that its stocks are more or less how do they are accessible through the national stock the Nairobi Stock Exchange, so it can they are posted there. So
No,
that is
no,
how I understand.
please. Take a seat, my friend. Take a seat. When you say national stock, first you're confusing yourself and you're confusing someone that is listening. When you say easily accessible, from your point, David, from your point, I can understand what you're saying. I know exactly what you're saying. But when I'm the marker, I don't mark like that. If I mark your paper, I will give you yes, I know what you're saying, but the way you're saying it is the wrong way. In my mind, I know, yes, David is right. Of course, they're accessible, but you can't say they're accessible. What is a word that I'm looking for? So you have to be very, very clear also in terms of even how you answer your questions in an exam. Don't throw just your answer so that the examiner might be able to fill in the spaces for you. No, it will end in tears. Kegei Anyanzwa. Kegei?
Of the Companies Act, public company, it allows its members the right to transfer shares within the company. And also, it does not prohibit invitations to the public to be able to subscribe for shares.
Okay. So the transfer of shares, they're transferable. You can transfer your shares to the public. You can transfer your shares to the public. That is the first main point. So that is, I don't know whether that is what David meant, but the first point is that you can transfer your shares to the public. I mean, you can freely transfer your shares. So public companies can transfer their shares. So that therefore means, guys, that if I come to your office and I'm telling you, I want to create a company that I can easily transfer my shares without any restriction, then that is a public company. It is as simple as that. So the first point is, aside from them having, of course, company secretaries, they also have what we're calling the easy or the transfer of shares in a public company is allowed. What is the next point? Kamiri.
Good evening. Now, of the major difference of one of the major characteristics of a public company is its certificate of incorporation clearly states that it is a public company.
Yes, but that is like saying this person is a man because the ID says he's a man. Or this person is a woman because she's dressed in a dress. Or this person is a man because he's having a trouser.
You see, like I have a private company and there is nowhere the certificate of incorporation says it is a private.
So what I'm asking you, Kamiri, is very simple. I come to you in your law firm. Where do you want to establish your law firm once you get admitted?
Kiambu town, where there are enough customers for asylum.
All right. So you want to establish your law firm in Kiambu town. So I come to Kiambu town and I look for Kamiri and Company Advocates. And I tell you, Kamiri, that Kamiri, I want to form a company or I want to form a business. I want a company. And I tell you the things that I want to do or the type of a company that I'm looking for. What will tell you from my speech that this person is looking for a public company? That is what I'm asking. At that moment, we don't even have the certificate of registration. We don't even have it. You're just being told in most questions that you'll see even in the past papers that somebody has come to your office and they're telling you this is the nature of the business vehicle they want. How will you know it is a public company? That is what I'm asking you, Kameri John.
I will start by asking you, how many members do you want to own shares? If there are more than one,
answer the question now.
Yeah, one of the other characteristic is that a public company has 7 or more shareholders.
Ulisikia wapi? Mary John.
Yeah.
Ulisikia wapi? Hiyo ulisoma wapi? All right, let's go to someone else. Kamiri, you're still reading the old act. You need to update yourself with the new act. All right, Wodhaya. Somebody call Wodhaya. Wodhaya, please speak to us.
Okay, a public company is required to have a minimum capital of 6 billion shillings.
Yes, that is a feature. Yes, that is a feature. 6.5 million shillings, not just money in the bank, but share capital. Okay, share capital. So it is a feature, yes. But what are some of the things? What are some of the things you will know? There are not so many. They're just obvious things that I'm looking for that will tell you as you read a question. Remember that even private companies can have share capital of even 10 billion. They can do that. But what are some of the things that will tell you when you read a question? Because this is also part of interpretation of a question and understanding a question. When you read down a question, what are those pointers that you look for? The first one is that there's free transfer of shares, that members of the company can transfer their shares freely within the company and out of the company, just like Anyanzo has already mentioned. What is the second one? Nyinyi watu, nataka niwasalimie. I have a team. I have a team that can come and say hi to you guys. Mnataka kunijaribu. Naluende Eli. Is it Eli? Elam.
It's Elams. It's a public company. I think it must have a minimum of 2 shareholders, and there's no set maximum.
Yes. So again, let's go back to the discussion of shareholders and members. Is it a minimum of 2 shareholders or a minimum of what?
Yeah, minimum of 2.
Shareholders or what?
Yes,
members or shareholders?
I'm not sure if it's members or shareholders, but it's a minimum of 2 and there's no set maximum.
Okay. Siganga Brenda.
Let me try. Must have the name must end with public limited company, PLC.
Of course, the name will be a PLC. Okay. It will be a PLC. Ojako Steven.
The company must have, public company must have at least 2 directors, and 1 must be a natural person.
Okay. That is obvious. What else? What else? What else? Sylvia Aricula. Guys, Sylvia, quickly.
Can you hear me?
Yes, we can.
It can invite members of the public to subscribe to its shares or debentures.
Yes, it can subscribe. I mean, it can advertise the shares. It can advertise their shares. So public companies can advertise their shares. And then the membership is from at least 2 members to no maximum. In the old act, it used to be at least 7. So that was done away with. So at least 2 members to no maximum. And of course, it must, if these are the only 2 members, all of them must be directors, because you must have at least 2 directors. Okay. All right. So those are the obvious features of a public company, that you can transfer your shares. Anytime you want. At the same time, you can advertise them to the public, and also membership. So if these people are saying there are 100 people, they want to be they want to form a business as 100 people, all of them, then you know it can't be a private company. It can only be a public company is because the membership. But if this person comes to you, is just one person, he wants to create a company for himself, that can't be a public company because for a public company, there must be at least two members. Now, let us go. Of course, there are other things that members have said. For instance, the name of the public company must end with a PLC. A public company must have at least a minimum share capital of 6.5 million. Share capital means you must have sold shares worth 6.5 million. And also, you know, the question of having a company secretary. All public companies must have a company secretary. All right, let's go to private now. What are some of the features of a private company? When I come to your office, I want to have a I want to have a company. What are some of the things that will tell you that this person is looking for a private company? Number one, put up your hand. Mora Omwenga.
The shares of the company are not transferable.
The word is
they are restricted.
Yes, they are restricted. The transfer of shares in a private company is restricted. Restricted. Okay? Now, what is the next one? Jane Ogalo.
The number of members is limited to 50.
What is the minimum? What is the maximum?
The minimum is 1 member, the maximum is 50.
So the membership is from 1 to 50. You cannot have a company a private company that has more than 50. But you can have a one-man company, which is a private company that has only just one member. Okay, so membership is between 1 to 50. Transfer of shares is restricted. And then what else? Last one, or any other difference? Brenda?
I think directorship is at least one director.
They must have at least one director. Just look at the list we provided for the public companies and give me the opposite of that. Yes, Wadaya?
Perpetual succession.
Where? No. What do you mean? All companies have perpetual succession. Thomas Ian.
Like
Thomas Ian.
Yes,
We can't hear you.
I think one of the characteristics is that it prohibits invitation to the members of public to subscribe to the shares or the debentures.
Yes, you cannot advertise the shares of a private company. A private company is a private company. It deals privately, and therefore you can't advertise your shares to the members of the public. Okay, so those are features of a private company. So the first one is that the transfer of shares in a private company is restricted. Restricted. Now, what is this thing that restricts the transfer of shares in a private company? What is this thing that is going to restrict the transfer of shares in a private company? What do we call it? Someone? Yes, Alan?
The articles of association.
No. Odhiambo, she's dropped. Susan Mora?
Just a trial. The memorandum of association?
No, not that. Omwenga Mora?
A trial, so preemptory rights.
Yes.
That.
The preemptory rights of existing shareholders, the right of preemption. So that is what is restricting transfer of shares in a private company. Let me explain what preemption means so that we are all on the same page. Now, if you form a private company, let's assume that myself, Jane, and Sylvia, okay, form a company, which is a private company. We do business for some period of time, and then at the end of the year, I want to leave. I want to sell my shares and leave the company. Okay. Now, I cannot just wake up and go and approach Bani Skimani and sell her my shares. Okay. Now, the right of preemption limits me, and it demands that before I approach someone, before I transfer my shares to anyone, I must first approach Jane and Sylvia. Okay, I must first give them the first right to say no belongs with them. So I will tell them, hey, we've done business for 2 years together, we've done successfully, but I want to leave the business. So I'm selling my shares at this price. Do you guys want to buy my shares? So they must first say no before you go and approach someone who is not a member of the company. So the first offer must be made to the members of the company, if it is a private company, and that is called the right of preemption. So they have to say no first. If they don't say no, you can only sell it to them and not anyone else. So until they say no, that is when you can go and approach someone else, okay, and sell the shares. So that is the right of preemption. So in a private company, the reason is very simple. It is a private company. We intended to have it private, and therefore we don't want to bring any other person on board, because when you transfer your shares to someone, okay, who is not a member of the company, you are now interfering with the privacy. So before you sell to them, first give us the offer so that we can decide whether we will want to buy it or we want to sell to somebody else. It's very simple as that. Okay? Very, very simple as that. That is the right of preemption. That is the right of preemption. Okay? It will also apply in terms of leases when you discuss leases in conveyancing, whereby the right of preemption demands that the government cannot renew a lease in another person's name without first giving the existing lessee the right to say no or yes. But anyway, let's come back to commercial. So that is public and private. Of course, membership is 1 to 50. If the person says they want a company that has more than 50, that is not a private company. And then you cannot advertise to the public. How do companies you shares in you? If you're watching television, if you're watching news today or watching whatever, you can't see a company directly advertising their shares on television or even on newspaper. They don't do that. How do they sell their shares? How do they advertise their shares? On the NSE, that is the Nairobi Stock Exchange. So when you log into the NSE, you will see different number of different types of shares or different classes of shares from different companies. So it is you to decide, mimi nataka hii ama nataka hii. That is the market of shares. But that can only be done by public companies. Private companies cannot advertise. Why? They are private. Okay? Even Safaricom, which is a public company, it started out as a private company. So when Safaricom went public by issuing the IPO, it was a private company and then it went public. We shall discuss that later. So that is the types, public and private. Now let us go to limited or unlimited. Limitation. Now, a company can only be limited either by shares or by guarantee. What is a company that is limited by shares? What is a company that is limited by shares? When we are saying that this company is limited by shares, what are we saying? Somebody, put up your hand. What is a company that is limited by shares? And what is the meaning of that? What is the meaning of that? Of us saying the company is limited by share? What is the meaning of that? Because it is important for you to understand. Okay? Yes, Ombai?
Yes, thank you. The meaning of a company limited by shares is that the liability of the members of the company is limited to the extent of unpaid shares of those members. Yes.
All right. Amiri, John, you want to add something?
Yeah, I think I agree with that speaker that it means that in case the company goes into insolvency, the members would only be liable to maximum the number of shares they have. They have released to the company. Otherwise, they cannot bear a higher responsibility or a higher liability than the amount equal to their shares.
All right. So that is what it is. So companies limited by shares. Now, like I have said before, Christina Roni, yes?
Sorry about that. I was trying to say that where a company is limited by shares, the liability of the company's members will usually be limited to the amount that is unpaid on the shares. And where the members have fully paid for the shares, then they are not liable to contribute anymore to the company.
Yes. Thank you. It is a very simple concept. Now, the first thing you need to understand is that what is limited is not the company. We usually say a limited company. It is not the company that is limited. Neither is it the members of the company that is limited. No. Okay? It is not the company that is limited, nor the members of the company that is limited. So what is this thing that is limited? What is limited is the liability of the members of that company. So when we say that you have a limited liability as a member of the company, we are simply saying that your liability as a member of the company is limited to the extent of the unpaid shares that you owe the company. And I'll make it a little bit simpler so that we are all on the same page. Assuming that you like milk and bread every morning, I mean a conventional Kenyan family, you buy milk and you buy bread. So in the morning of Thursdays, tomorrow, you wake up in the morning, you go to your local shop and you need to buy milk and bread. But you realize you have 100 shillings and that 100 shillings can only get you milk, but not bread. So you tell the shopkeeper, give me the milk and the bread. I will pay for the milk right now, and then for the bread, I will pay later. Okay? So the shopkeeper gives you milk and the bread. You go home. Now, in the evening, when the shopkeeper is doing the math to close down the business for the day, they will give you a call and they will tell you, hey, you took milk and bread in the morning. You paid for milk. You've not paid for the bread. Kindly pay for the bread. In other words, your liability to the shopkeeper is limited to the value of the bread. So if that bread is 85 shillings, you will send the shopkeeper 85 shillings. If that bread is 50 shillings, what you owe the shopkeeper is 50 shillings. So your liability is the value of what you have that you haven't paid for. Now, in the context of a company, when you buy shares in a company, when the company allots you the shares as the initial members of the company, sometimes the company has a policy that for the initial members of the company, we will give you some shares. The policy is you pay for half of them and then half you pay later. So the half that you've paid for is what you're calling the paid up share. You've paid for them. And then the half that you're yet to pay for is called the unpaid up shares. So later in the year, if the company is looking to raise more money and more capital, or the company is undergoing insolvency. Insolvency simply means the company is broke. It doesn't mean liquidation. The company is just broke. Then the company will give you a call and they will tell you, member X, Y, and Z, you took 1,000 shares, you paid for 500, you are yet to pay for 500. Please pay for 500 that you've not paid for. And that means your liability to the company is limited to the value of unpaid shares that you have. So if the company has shares, it means you bought shares from the company, and therefore what you owe the company is just the value of the shares that you have. So if you've paid for half of them, you owe the company half. If you've paid for everything, you owe the company 0 shillings. That is what you're calling limitation by shares, and that applies in companies that have shares. A company that has shares, the liability of the members will be limited. If it is a limited company, it will be limited to the number of shares that the member is holding that they are yet to pay for. That is exactly what we're saying. So in other words, we're saying that right now Safaricom is going under. Or let's use which company? Which company do you think is going under next? There's a trend in Kenya that businesses are just going under next. Which is the next one? Someone? You know which one? You guys don't read financial markets, do you? Mnaishi tu. Yojako, Steven.
Standard Media Group.
Yes. There are two companies that are not going to survive. The first one, the main culprit, is Naivas. Naivas will not survive a long time. Naivas will go under very soon. So Naivas will go under. That is something you can take to the bank. The next one is the NMG. I mean the standard SMG, the Standard Group. Standard Group is having troubles and they're suffering. So if you don't know, Standard Group is the owner of the Standard, KTN News, and all that. So assuming that you're a shareholder at Standard, okay, you are one of the shareholders at Standard. You took 1,000 shares, you paid for half, you've not paid for half. When Standard Media is going through insolvency, the liquidator of the Standard Group will give you a call that, hey, Kamiri John, from our records, you are a shareholder here. This company is going under, and therefore we want to collect as much money as possible. So you owe us some money. So kindly pay us what you've not paid. So your liability to the company or your liability to the creditors of the company is limited only to what you've not paid. It means they can only come for what you've not paid. After you pay everything, that is all. The company can be liquidated and you go home nicely. It will not follow you home because you have limited liability. The second one is limitation by guarantee. Now, guarantee is whereby you sign a guarantee. You guys know guarantors. You guys might have gone to school using the higher education loans board funding, that is the HELP funding. You know, when you apply for that, they need you to have guarantors. You guys have gone to banks to borrow loans, even from SACCOs, you know, you've seen guarantors. You need to bring a guarantor. Now, a guarantor brings a guarantee that, hey, huyu akishindwa kulipa, mimi nalipia yeye. That is a guarantor. So what is a company that is limited by a guarantee? So when members of the company are creating the company, they will sign a guarantee, a statement of guarantee, telling the company and the members of the company that, look here, should this company go into liquidation, should this company go into insolvency, mimi personally nitatoa shilingi milioni moja. Mimi personally, I will contribute 2 million. So that is the guarantee. So your liability to the company is limited to the amount of money you guaranteed to pay. So if the company is suffering, sisi tutakupigia tukwambia, hey, mzee, you promise to pay 5 million when if the company goes into insolvency. Ni sasa hivi, tuma. Na utatuma kwa hiyo number. So that is what you do. So if you don't send, they will auction you and get the 5 million from you. They will sell your personal properties until they get the amount of money. So that is guarantee. So it is very, very simple, very direct. That is how you deal with limitation. So that is limited companies. So limited companies, the liability of members are limited. What is the meaning of liability of members being limited? It means shida za kampuni haziwezi kukufuata mpaka kwa nyumba yako. It is limited. Liability is limited. If the company is having a problem, the problems of the company cannot follow you home because your liability is limited. The second one is unlimited companies. Unlimited companies is now the opposite, that the problems of the company will follow you mpaka chini ya kitanda yako nyumbani. You will have problems with the company and you will pay the company debt. Even if they will have to sell your bed, they sell your house, they sell your car, they sell you. You will have to pay the debts of the company because liability is unlimited. It is unlimited. So what you owe the company is unlimited. Are you together? So it will extend to your personal property. So they will sell your personal property. So that is limitation. So if you get into a question and you're being told that James and John, get this question and give me the answer quickly. James and John has come to your office. They are saying they want to form a company or they want to form a business vehicle. They want to have 100 shares. Okay. They want to have 100 shares and they want to minimize, or they want to trade privately, or they want to minimize any public exposure. They don't want to give their books of accounts to the public for scrutiny and everything else. Which business vehicle would you advise John and James to form? So what is the business vehicle there? Somebody. Come on, come on, come on. Caroline Wahoo.
A private limited company.
Private limited company. Limited by what?
Limited by shares.
Yes. That is how you answer that question. So don't say public company. Don't say private company. Don't say limited company or unlimited company. No, that is half. So tell us a private limited company that is limited by shares, because it has shares and debt. So that is simply how you answer questions in that. And then, of course, the next thing you need to understand is that the moment you say private company, then every feature of a private company will come to your head. The moment you say public company, every feature of a public company will come to your head. And that is how you deal with that. Now, let us go to any person having a question. I don't know whether I'm speaking from, we are on the same page, but these are things I want you to understand. So we are moving very slowly though, but it's worth it, trust me. So we've done the general features that I want to understand. We've done the characteristics of a company, advantages of a company, and now we've done the types of a company. Now let us talk about the registration of a company. You as a corporate student, a corporate law student, you want to get into corporates the moment you get done with KSL, you want to start doing things here and there, you want to start making some quick money. Some of you are already masquerading. Continue masquerading. Some of you are already going to court and appearing. Itakuramba siku moja. But as a student of company law that is getting admitted very soon, the quickest way to make money is through registration of company. That is the quickest way you can make money. The quickest way to make money as a new advocate is just to register companies. So you need to know how to register companies. How do you register companies? Now, registration of companies is done through eCitizen. But kuna wenye wa kwa hii class sahi, they don't have eCitizen accounts. Yani wako tu, kila kitu inaendelea tu sawa. Kukula mara 3 kwa siku. Kulala 9 hours. Manifestation kama kawaida. Maji 10 liters. Lakini they don't have an eCitizen account. Guys, you can't do that. You can't live like that. You're a lawyer. When you become a lawyer and an advocate, you need to do transactions. You need to pay taxes for your clients. You need to register motor vehicles for your client. You need to register land, conduct searches, register companies. You can't do them without eCitizen account. So I know you're very busy. You need to get some quality sleep and glow in your sleep. Take some 30 minutes tonight and get yourself an eCitizen account. okay? Because once you get admitted, the fast, quickest way of getting money is the registration of company. So let's register company. Let's see, how then do you register company? What are some of the things you will need for you to register company? I walk into your office. I'm telling you, Mimi ni investor. Yeah, Mimi ni investor. I'm an investor. I want to start a business in Kenya. I want to register company. What are some of the things you will require from me so that you can proceed and register the company for me? Put up your hand. What are some of the things you will need for you to register the company for? What is the checklist? So that's exactly what I'm asking. What is the first question you're going to ask me? What is the first question you're going to ask me? Hey, I want to register a company. What is the first question you're going to ask me? Somebody who has not spoken, tafadhali. Kila mtu aweke mkono yake juu. And if you don't put up your hand, I'm going to mention you. I'm going to call you by name. And I know all your names, including the names of your grandfathers. So I'm going to call you by your great-grandfather's name. So, weka mikono juu. If you don't put up your hand, I'm going to call your name. Very simple thing. Don't confuse it. Don't complicate it. Okay. Okay, fine. So let us start with John Adams. Adams John, what is the first question you will ask me? I am a client in your office. Where do you want to establish your office, John? Where is your office first?
Runda.
You want to establish a law firm in Runda? Okay. Fine. So nimekuja Runda. Nimekuja Runda and I want to start a company. And what is the first thing you'll ask me?
Guess what type of company? The private, limited, public, unlimited.
Yeah, so let's take it. So the first thing you need to know is what is the type of a company you need. Okay, so I will tell you I need a private company or a public company. Public limited or private limited, whichever. Okay, what is the next question that somebody will ask me? Yes, Kamau. Kamau Mungai. Kamau is a very rare name. Very, very rare name. I don't think people called Kamau are so many. Are they existing? It's a long time since I had this name Kamau. Specifically Kamau. It's a very people from the mountain. Did you guys stop naming kids Kamau? Because it's a name that is dying. So when I see a Kamau, I am happy. So Kamau, please. Kamau, please say something. Kamau Mungai. What is the next question, Kamau? Kamau is not there. Julius Oduol. What is the next question you'll ask? What is the next thing in the checklist? Yes. Who is speaking? Somebody speak. Julius Oduol is not there. Yes, let's go to Yusra Kinango. Guys, are you? I can't hear you. You guys are not. Is it network or is it my device is too strong for your devices? Huh? Yes, Kinango, proceed.
We're going to ask the details of the directors, their name,
Where?
the number of directors you want for the company.
You
Okay, not
can't ask that trust. You can't ask me that even before you. There's certain things, the type of a company, yes, I need to know that. What else do you need? Guys, you guys have registered companies, assuming so. What is the first thing you input? When you log into a citizen, your password, register business, register public limited company. The first thing, what do you put there?
Name.
Akinyi Ouma.
Whether it's limited by shares or by guarantee.
Limited by shares or guarantee. Yes, that is still part of the type of the company. Aside from that, Waire, Anthony.
Business name. So when you log in, it will ask you like for 3 business names. So yes, we will need to know. I will need to know the business names you want me to register.
Not business name. It's not a business name. The proposed name of the company. Proposed name of the company.
Yes, proposed name. Yes, yes.
Yes. So you need the names. You cannot ask somebody who are the directors before you ask them who are the names. So the name and the type of the company will come first. The name and the type of company that you want. So remember, when you log to your eCitizen, the first thing you're going to click is the type of the company that you want. Private, public, limited. Private, limited, public, limited. So once you click private limited, the next thing is the name of the company, proposed name. So after that, you can open the checklist now. So apart from the type and the name, what else will you need? Now name them randomly. Kamau, I'm still on you. I can see your hand is up, but you're not speaking. Your name is very special. Okay, Wambui Jen.
The location of the company, where it's located, the street, PO box.
The proposed address of the business, proposed address of the business. Yes, you need the proposed address of the business. Yes, Brenda Siganga. Address will include all those things. The email, the physical address, the postal address, email address, all those are part of addresses. Siganga.
I think the memorandum and article of association.
The memorandum of association and the article of association. The article is the constitution of the company, and then the memorandum of the company is like the register of members and the declaration. So memorandum of association and the article of association. Now there are 3 ways of getting a memorandum. The first way is you can adopt the model articles. So when you log into the eCitizen and you're creating a company, normally you will have the model articles. They are obvious for all private companies and all public companies. Number 1. Number 2, you can amend the model articles. You can take the model articles, but you amend a few things to fit your circumstance. Then the last one, you can always draft your own articles of association. Now the articles are the constitution of the company. The articles will define everything in the business, everything in the company. Okay. Well done. What do we need to go next? Well done.
Particulars of the directors.
Yes, the list and details of directors. So the details of the directors, yes, of directors. What do you need else? Kamau Mungai, your hand is still up. You're not saying anything. So sad. Yes, Caroline?
You also ask for the statement of the nominal share capital and the initial shareholding if limited by shares, or the statement of guarantee if limited by guarantee.
Perfect. So if it is limited by guarantee, statement of guarantee. If it is limited by shares, then the shareholdings. So that is the statement of share capital, which you just input in your eCitizen, and then it will generate it for you. Anything else? Anything else that you've not mentioned? Something to talk about section 28? Yes, Zaweria Nyambura.
The nature of the business.
The nature of the business. What is the fund? What is the object of the business? What is the nature of the business? Are you into consultancy, legal, tax, charity, whatever? The nature of the business must be very clear. Yes, Sylvia? Arekula, Sylvia.
The liability of members.
Of course, liability of members is obvious. The moment the moment you mention shares, then automatically liability is limited to that shares. The moment you mention guarantee, it is limited to the guarantee. Guys, those are the details you need. So you need the name, the type of the business, the name of the company, details of shareholders, details of directors. If it is limited by shares, you will need statement of share capital. Limited by guarantee, you need statement of guarantee. You need the proposed location of the business, proposed details of the nature of the business. So is it charity? Is it whatever, manufacturing, whatever you need to do with that thing. So those are the things you will need. That is a checklist. So make sure you know how to prepare the checklist. Also in an exam, if you're told to prepare that checklist. So that is something that you ought to understand. And then of course you proceed and submit the documents, and then you pay your 10,000 Kenya shillings. And then you will register the business. The company will be registered. Now, any question? Yes, Sombai?
Yes, on the details of directors and shareholders, I'm asking if the beneficial owners of the company are different from the shareholders you've added. Is it a requirement that you add the details of the beneficial owners, if at all they're different from the shareholders added?
Yes, you have to add the details of beneficial owners of the company. So generally, the beneficial owners of the company are usually the shareholders, the original shareholders, normally, but not all the time. So if they're different, of course, you'll still have to give us the details of the beneficial owners. Who are the beneficial owners of the company? At the end of the day, this money, where is it headed to? If the company makes a profit, who is the ultimate beneficiary of this money? That is what you're calling the beneficial owners of the business. So most of the times, the shareholders are the beneficial owners of the company, and therefore it's obvious. But if that is not the case, then this person might have to disclose and give you the details and particulars of the beneficial owners of the company if they are not the same. Okay. Proper, clear?
Yes, you are.
Okay, next question, Alan.
Yes, Mwalimu, you indicated that a public company can issue a prospectus, which is a written invitation to the public to take up shares, but a private company cannot freely sell its shares. Why is that?
It is obvious. Let me ask you. Are you married, Alan?
Yes.
All right. So let me use that example. Let me use another example of Alan. Let's assume you have a business, Alan. Let's assume that you and Anthony, you have a business, you have a company, which is a private company. By the fact that that company is private, it means that you and Anthony don't intend to have any other person from the public or any other third party to come and be part of your business. So when you have a private company, what is the meaning of that? What is the meaning of that? The meaning is this is a declaration you're making that me and my other shareholder, who is Anthony, we don't want anyone to interfere with our business. We just want to do business together, the two of us, privately. So by the essence of that, the company remains private. And because it is private, Anthony cannot decide to sell his shares to Brenda. Because when you sell your shares to Brenda, Brenda will now become a shareholder. When Brenda becomes a shareholder, that already interferes with the privacy that you and Alan were having. Now, for that reason, you as Anthony, you must first go and consult Alan and tell Alan, look here, my friend, we've done business together for 5 years, but I'm tired. I need to retire. I don't want these shares anymore. But because of the respect of privacy that we have as a private company, I want to leave. But before I leave, do you want to buy my shares? Or should I go and sell them to someone else? Then Alan will say, fine, because this is a private company, mimi sitaki kudeal na mtu mwingine, wewe niuzie hizo shares zako. Okay, so that is what we're saying, that because of the entire essence of being a private company, it is supposed to be private to the initial and the individual shareholders. And therefore, you can't just sell your shares anyhow the way you want, because you will be interfering with the privacy of other existing shareholders. And that is why the law gives them what you're calling the right of preemption. Now, the right of preemption simply says that before you sell, because at the end of the day, you will have to sell. But before you sell, please give them the first option so that they can have the option of retaining the privacy and buying the shares and maintaining the privacy of the company, so that you don't bring foreign people to come and do business when it's the same thing. That is the logic behind it. It is a private business, so bringing another person will not maintain the privacy. But if it is a public company, you can sell whatever you want to anyone at any time. You get the logic, Alan?
Yes, I do.
That is the reason why in a private company, you can't just sell your shares anyhowly. You have to consult the existing members because those members have the preemption right. Yes, Siganga Brendan, what is your question?
No, I think this hand was for before. Sorry.
Okay, fine. So that is the question to do with registration of companies. The next thing that I want us to look at is the question to do with the membership. Membership. Okay, the members and the membership. So let us walk into it. So I've said, guys, members of a company are those that have bought shares and have signed the memorandum of association of the company. The memorandum of association of the company. Okay? The memorandum of association of the company. So when you sign the memorandum, you become a member. Okay? It's like a club. Okay? You know those clubs, those private clubs, Nairobi Club, the Karen Golf Club. So members of those, if you're a member of a club, you guys have signed, you paid the membership fee and you've signed somewhere. That facility can still be accessible to other people, but they're not members. Okay, some people can still come to the facility and use them and pay, but they're actual members. So for you to be a member, you have to sign somewhere. So that is membership. So in terms of members, I want you to understand just who is a member, and then the question of protection of members and the rights of members. That is what I want us to discuss. And then we can call it a closure. Okay. Now, a member is a person who has bought shares and he has signed the memorandum of association. That is a member of a company. Okay. Now, what are some of the rights of members of a company? Now, remember, and I'm making it easy for you, that members of companies are natural persons. Sometimes natural persons and sometimes they are corporate persons. The normal human rights in the Bill of Rights under the Constitution will be the rights of every member. So every member will have all the rights as per the Constitution. So the first one, even freedom of movement, dignity, privacy, right to access to information, non-discrimination, all those rights, right to fair administrative action. You know, all those rights are rights of members of a company. So if a company violates your right right against discrimination, then you can always sue for that. So that is where you start from. All the rights in the Bill of Rights will, of course, be rights of members of a company. And then, of course, we have other rights that are now within the context of the business. So the first right, of course, in terms of meetings, every member will have the right to receive notices to meetings. As a member of a company, you have the right to receive notices to the meetings. Notices to the meetings. Okay, so if a meeting is being held next week on Tuesday, you must be given a notice. Every member must receive the notice. Number two, every member has the right to attend the meeting. The right to attend meetings. You have the right to attend the meeting. Aside from attending, if you're not able to attend the meeting, every member has the right to appoint a proxy. You can appoint a proxy, and the proxy is now the person that is going to attend on your behalf. So you don't have to attend in person. You can always attend by proxy. Appoint someone to attend on your behalf. So that is the third one, the right to appoint proxies to attend. Now, at the attendance, once you've attended the meeting, the next thing or the next right that you have is you have the right to participate in the meeting. You have the right to participate in the discussion. So they cannot pass a resolution and say, hey, you can't participate. Every member has the right to participate at the meeting. The next one is the right to vote. Every member has the right to vote. You know, some of you here don't even vote. They don't even vote. If we can conduct a random search here, you'll find that a lot of people here don't even vote. They don't even want to vote. Very sad. Go and vote on the Tuesday, 27 August. Make sure umepiga kura. So every member has a right to vote. Mliambiwa serikali ni ya shareholders. So shareholders tafadhali, you have a right to vote. Okay? Kama wewe ni shareholder wa serikali, tafadhali chukua kura na uende pige kura. All members, all shareholders have a right to participate and they have a right to vote. All members. And then after that, if you don't have if you don't attend physically as a member, you have the right to appoint someone to vote for you. You can appoint a proxy to attend on your behalf and to vote for you. We're together, guys. So that is the right to vote. And then after the voting, you have the right to receive copies of the resolutions. You have the right to receive copies of the resolutions. So if there are resolutions that have been passed, you have the right to receive those resolutions. After voting, of course, the company will be circulating and saying, this is what we discussed. These are the resolutions. Every member must receive the copies of the resolution that have been passed at that meeting. Guys, are we following each other?
Yeah, we are.
Anyone confused? Any question? All right. Sawa. Now, the next question is the protection of the right of members. Protection of the right of members. And let me try and see if I can project my screen. You see my screen?
Yes, we can.
Yes.
Okay.
Yeah, I can see.
I'm trying to zoom it. Okay, there it is. All right, so protection of members. So there are two things here. There's what you're calling the protection of members against the oppressive conduct and the unfair prejudice as members of the company. And then there's what you're calling derivative suits. I'm going to explain the difference and how they both come in. Now, the first one is the question of protection of members, but you can't understand protection of members until we go back and explain some few concepts that I've already explained. The first one are the normal rights of members. So the protection of members, as you can see on your screen, will come from the normal rights of members. So every member will have a right. All the rights in the Constitution, as well as the rights that we mentioned. Okay, they have a right to do certain things, to receive certain, by virtue of them being a member. Now, if any member of the company feels like their right or a conduct of the business or of the company is prejudicial and oppressive to them, then they will proceed and file an application in court to seek the protection of the court. Now, who are these people that are often prejudiced in a company? The minority shareholders. Remember that if you're the majority, nobody can prejudice you or nobody can oppress you. If you're a majority, of course, you are ranking higher than you can call the shots. But now the people that are often oppressed are the minority shareholders. These shareholders that don't have the say, they're the minority. Now, if you are a minority and you feel like something by the company is oppressive, then you shall run to court and have the court correct that. So I want somebody to read for us section 780. Somebody read for us section 780 of the Companies Act as projected on your screen. So that
part 29, protection of the members against oppressive conduct and unfair prejudice. 780, application to court by company member for order under section 786. 1. A member of a company may apply to the court by application for an order under section 782 on the ground A, that the company's affairs are being or have been conducted in a manner that is oppressive or is unfairly prejudicial to the interests of the members generally, or of some part of its members, including the applicant, or B, that an actual or proposed act or omission of the company, including an act or omission on its behalf, is or would be oppressive or so prejudicial.
Yes. So let us go to 782.
782, power of the court to make an order, to make orders for oppression,
to
make orders for protection of members, or members of oppressive conduct and an unfair prejudice. 1.
Kamiri John. Calm down. Can you read that very well?
Powers of the court to make orders for protection of members against oppressive conduct and unfair prejudice.
Right.
1. If on the hearing of an application made in relation to a company under section 780, the court finds the grounds on which the application is made to be substantiated, it may make such orders in respect of the company as it considers appropriate by giving relief in respect of the matters complained of. 2. In making such an order, the court may do all or any of the following. A. Regulate the conduct of the affairs of the company in the future. B. Require the company, 1, to refrain from doing or continuing an act complained of, or 2, to do an act that the applicant has complained it has omitted to do. C. Authorities will proceed or authorize civil proceedings to be brought in the name or on behalf. Scroll down, please. Authorize civil proceedings to be brought in the name or on behalf of the company by such person or persons and on such
I've lost you, Kamir. I think it's my network.
make C, request the company not to make any or any specified alterations in its articles without the leave of the court. E, provides for the purchase of the shares of any member of the company by other members or by the company itself, and in the cases of a purchase by company itself, the reduction of companies. Scroll down.
Mm-hmm.
I can't see yet. Provide for the purchase of the shares of any member of the company by other members or by the company itself, and in the case of the purchase of the company itself, the reduction of the company's capitals accordingly.
All right.
Thank you.
Just leave it there. So essentially what I'm trying to say, or what you're trying to do, is to look at the modalities around protection of members. So first, guys, I don't want to take you quickly and confuse you along the way, but I want you to understand where we are coming from. So we introduce company law and we say there are certain aspects that you need to understand as a company, or in light of a company. Okay. We've talked about types of companies, advantages of companies, and even the process of registration of companies and the checklist that you need to have whenever you're registering a company. Now, right now, we are talking about the question of membership and shareholding, which we have already mentioned, that a company, of course, must have members. Of course, there's a minimum of 1 for every private company and a minimum of 2 for every public company. Now, we talk about the rights of members in a company, and we have said that each and every member of a company will have the rights that we have mentioned. Just if you forget those rights, just remember the Bill of Rights. So a company, guys, can you hear me?
Yes.
Yes. All right. Thank you. Now, so if you forget everything, just remember the Bill of Rights, because that is where the rights are. So even in a company, the company must still treat all its members with some kind of respect for the rights that are provided in the Constitution. Okay, and I've given examples to be dignity, privacy, non-discrimination, access to information, and all that. Okay, now, in case these rights are not adhered to, that is why Section 780 comes in, and we start speaking about the question to do with protection of members against oppressive conduct. And how does oppressive conduct come in? How is it coming in? Now, remember that the majority shareholders will always be running the show. The majority shareholders in a company will always be running the show. Why are they running the show? Simple. I've already explained that a company will always be run through resolutions. Decisions of a company will always be in form of resolutions. Now, these resolutions, sometimes, because they are passed by the majority will have the say, and the minority will have no say. Just like Parliament, the majority will pass a bill that they want to pass, and the minority will do nothing about it. Same thing, even for a company. So a company will pass a resolution. So if you feel that a conduct of the company is being prejudicial, is being offensive, is being oppressive, then you can run to court under Section 780 and you can seek a remedy from the court. Are you together? So that is one of the things that you need to understand up to this point. You can go to court, and when you go to court, remember that this application can also be made by the Attorney General. So when you go to court, then the court may make an order either requiring the company to do X, Y, Z, to reverse the order, to quash the order of the company, or the court can require the company to to do something or to refrain from doing something. So generally, the court will pronounce itself, okay? The court will pronounce itself on that matter by simply entertaining that application. So you file an application. So that is protection of members against oppressive conduct. Is there any question about membership in terms of, number one, the rights of members and then the protection of members? Do we have a question up to there? Because I want to mention something on the next one, which is derivative suits. Do we have a question? No? Okay. Now let us go to derivative suits and explain what derivative suits are. Now guys, commercial generally are just concepts. You just need to know the concept. That is all you need to have. Just the concept. Are you together? You just need to know the concept. Once you understand the concept of even membership, that is all you need to have. Just have it at the back of your mind. There are no theories, there are no case laws. Sometimes it can get boring, but it is what it is. Game of concept. So we've talked about membership and protection of members. Now let us look at derivative suits. What are these things we are calling derivative suits? What is a derivative suit? Now, remember that you as a member, when you are oppressed, you go to court under section 780 and make an application. Okay, so that the court can protect you from a prejudicial conduct by the company. However, when that prejudicial conduct is affecting the company and not affecting you, then you bring a derivative suit. So a derivative suit is a suit that is brought by a member of the company in the name of the company against a director of a company or a third party. I don't know kama tunaelewana. Let me give an example. Protection of members against oppressive conduct under section 780 applies to instances where the specific member or members are the ones that are being oppressed, that this specific order of the, direction of the company or resolution of the company is affecting these specific minority shareholders or members. So they will run to court for an order against the oppressive or prejudicial conduct by the company or by the majority shareholders of the company. Okay? But now, in the instance where the action that is complained about is not affecting the member, but affecting the company, at that point, we start talking about derivative suits. Now, what is a derivative suit? Now, let us go to the general principles of a company that we discussed. A company is a separate legal personality. Okay? Now, that means a company can sue and be sued in its own name. A company can sue and be sued in its own name. Okay? So that therefore means that all the suits are supposed to be brought by the company in its own name. Okay? Number two is the question of the indoor management rule. The indoor management rule. We will discuss this rule, which is a rule in TAC1s. You know that the TAC1s case was the role. Is it the role of method? Yes. So the rule in TAC1. So the rule in TAC1s simply it establishes a lot of factors or a lot of principles, but the main one here is the indoor management rule. Now, what is the indoor management rule saying? That everything that is happening in a company should be handled within the company. That the company is able to handle its internal affairs internally. So we don't need to go to court. So that principle and the principle of separate legal personality that requires that a company can sue and be sued all together will give us what you're calling a derivative suit, because this is an exception to that rule. Okay? So in an instance where a director or directors of a company are running the affairs of a company in a manner that affects the company itself, then any member of the company can go to court and sue on behalf of the company. So when you're suing on behalf of the company, then that in itself is a derivative suit. Essentially, the company should sue on its own behalf. But the company can't do that because the people that are running the company are the same people that are doing the wrong things to the company. So if the majority are, for instance, they pass a resolution that they're going to increase their salaries, they're going to borrow some money and squander some money. There's some elements of fraud, forgery, negligence that is affecting how the business is operating. It's really affecting the business. It's running down the business. Then you, as a concerned member of the company, you will run to court and tell the court that, look here, Your Honor, these people are killing the company and the company cannot fight for itself. Somebody had to do it. Okay? So I'm coming here and I'm suing on behalf of the company because I'm trying to save the company. Now, differentiate that with suits for oppressive conduct. So in the first instance, the issue was affecting you as a person and you went to court under section 780. Now, in this second instance, it is not an issue that is affecting you personally. It is affecting the company. Okay? And therefore, you're going to bring a derivative suit. So a derivative suit is a suit that is brought by a member of the company on behalf of the company against a director of the company or a third party in the company or a third party of the company. Are you guys together?
Together.
Okay. So what are the grounds? What are the grounds of bringing a derivative suit? So the question
Can I just
is,
infer something friendly? Sorry. Can I just ask something kindly, if you don't mind?
Yes, yes, okay.
Do you need to seek leave of court before you bring a derivative suit before court of law?
Course.
Kindly.
Of course, you have to get leave. Because when you go to court, you have to convince the court. You have to convince the court why you, because remember, it is not just the court must give it a go ahead because it is an exception to the rule. What is the rule? Is a company can sue in its own name. The company doesn't need you to sue on its own behalf. Why are you suing on behalf of the company? The company can do that itself. So you have to show the court why. And what is the reason? Very simple. That these people that are supposed to bring this suit against this person, they are not doing that because they are the same people that are culprits. So if they're the culprits, they can't sue for the company because they can't sue themselves. So that is that. That is derivative suits. So the first thing we have said about derivative suits is that the remedy must be vested in the company. The remedy must be vested in the company. And what do we mean vested in the company? The remedy, the ultimate beneficiary of the remedy, when the remedies, when orders are given by the court, the person who is supposed to be enjoying those orders should be the company. Okay, should be the company. If it is not the company, then that is not a derivative suit. Okay, who can bring a derivative suit? That I've already explained. It is by a member of the company, a member of the company, any member of the company or members of the company. Okay, number two, against whom? Against the court. Sorry, against the directors of the company. Okay, so a director of the company or any other third party. So for instance, if there's this third party that is that has been contracted by the company to supply something, is being paid but is not supplying anything. So in other way, is also taking part in squandering the company. You can sue the third party on behalf of the company. Are we together? Now, grounds. What are some of the grounds of derivative suits? What are some of the grounds that must be there for there to be a derivative suit? that this director has been negligent. Negligence is a ground for derivative suits. Number one, negligence, that the director is negligent, acting negligently. The other one is breach of duty. The director has breach, or these directors are breaching their duty, breach of duty, breach of trust, fraud, misrepresentation. Okay, those are the obvious grounds for a derivative suit. Those are the obvious grounds for a derivative suit. Now, what is the relationship between derivative suits and suits for the oppressive and prejudicial conduct? Now, this is the relationship. If you go to court and you tell the court that the affairs of the company under Section 780 are being run in a manner that is affecting you as a member, that you are being oppressed, as a member of the company. If you go to court and you tell the court that you're being oppressed as a member of the company, and then the court looks at that application of yours, and the court makes a decision, or the court realizes, okay, the court realizes that that aspect, or you are not the only person that is affected, that this specific remedy is also, or this specific conduct is also affecting the company. It is affecting you and affecting the company as well. Then the court will convert that suit to become a derivative suit. Are we together? Yes, Michael.
Jackson, I had a question about this entire thing about derivative claim. How do we balance it with the principle set in the case of force versus bottle, which provides for non-intervention by courts in internal company matters?
Yeah, that is what I've said. That is what I've said, that this is an exception to the rule. It is an exception to the rule, of course, the rule in Harbottle and the rule in Taquans. The indoor management rule. The indoor management rule is the one that says that, hey, vitu za kampuni zibaki ndani ya kampuni. We don't need to interfere with the way the company is being run. Why? Because the company is run on the basis of resolution. The majority will always have the say, and and the minority will have their way. That is the rule when it comes to company. So the court will, of course, cautiously interfere with that if the court is convinced that that is the right thing to do. Okay, and that's what I've said. Derivative suits are exceptions to that rule. First, it is an exception to the rule of the indoor management. At the same time, it's an exception to the rule of the company being able to sue us as a company on its own volition. Okay, so it's an exception to the rule, but it creates parameters. So it must be by a member of the company against a director, but on behalf of the company or against third parties. The grounds, I've already mentioned the grounds. Any question up to there? I'm opening the floor for questioning. In the next class, we will explain more on liability, pick from the rule in Taquans, go to directors, liability of directors, resolutions, meetings, and then we shall talk about the question of shareholders and shareholding and everything else. We have time, but for now, in the next, we are almost out of time, but in the next few minutes, please go back into the very first thing I said when we joined the class up to right now and ask as many questions as possible so that I can be able to explain some of the things that are not making sense for you. And I must warn you, please, 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 do not be shy. Ask those questions because you can't leave this class and you don't understand something. Ask, I will explain, and you will go having fully been satisfied that your answer has been given. So please say something. Is it your submission that everything is okay?
Excuse me.
Tua, yes, Tua.
I have posted a question in the chat. Kindly can look
Just
at
say
it.
it. Just say it. You're already
Okay,
on the mic.
how do you approach the court in both instances for a
Very
derivative suit and for an oppressive conduct?
like just
The
like
pleading that you
insolvency.
use.
We have special documents, the standard forms under the regulations. The standard forms under regulations, you just fill them out and file them in court. They are not the normal plaint whatever. There are special forms in the rules. But where there's no special form in the rule, you just use the normal notice of motion for every application. But most of the forms are in the rules. You just the standard form, standard documents. Are we together?
Yes, thank you.
Okay. Any other question? Aki Nyinyi, say something. You're good? You're fine? Okile.
I just have a general question about these unlimited companies. By the reason of someone choosing a company as a business vehicle is to mostly reduce a business liability. So how does this work? Why will someone go for an unlimited company?
For unlimited companies, usually just to avoid a lot of regulations, avoid a lot of pressure. Plus, remember, if it is limited, you'll have to have shares. You'll have to have shares, and if you have shares, of course, you have to file returns and do everything in. So normally, it's just some people don't want they want to merge. Of course, it is an insane decision. You'll be wondering that mbona mtu atafute unlimited. Yes, you can still have unlimited, and that means that you will share everything with every property that you have, every personal asset of yours will be used by the business in case of liability. So normally people just want the easy way out, but of course it comes with grave consequences at the end of the day. And also remember that nobody will trust you if you have unlimited company. Nobody will trust you, because that therefore means that your liability is not limited, and also you don't have shareholders. When you don't have shareholders, nobody trusts you. So it's really a funny question in terms of why would I want to have unlimited if I can have limited? But yes, some people still have unlimited because they don't really care about liability being limited. They just want to do a business and they want to become part of the business. Okay, they want to become part of the business, so that will give them the opportunity to run the business the way they want, and therefore they will prefer unlimited. Okay. Are we together? Waire, is it? Okile?
Yes, we are together.
Okay, Anthony, say something.
Yes, Jacktone. So my question is on limited companies. You had talked about, say, for example, limited by shares, and during, say, solvency, say, for example, I'm called upon as a member who has unpaid shares, then to make good my payment. I was just trying to find out how practically say the debtors can force me then to make this payment, be it say I'm limited by shares or even limited by guarantee. So how will I be forced practically to then pay up, say, the amount I had guaranteed or the amount that I have in unpaid shares? Thanks.
All right. Were you a beneficiary of help? Let me ask.
Thankfully, no.
All right, you feel like, let me use another example. Now, when the company goes into liquidation, we will give you a call. The person who has been appointed as the administrator or the liquidator will call you and tell you, Anthony, we know you. We know where you are. Please, pay up. If you don't pay up, they will attach your property and sell. Attaching your property is very easy. They just look for a private investigator or even an auctioneer. The auctioneer will do the work of tracing you and say, fine, Anthony works here, Anthony has this property here, Anthony, they will proclaim it, and then they will sell it. So kulipa si shida. So long as you're alive, utalipa. Ama utaenda jela. You'll have to pay. There's no other way. So the moment you have unpaid shares of a company, that is a debt. And that debt is recoverable under just like the normal debt. Kama uko na deni ya mtu ya 50,000, alikupea deni na hujalipa, si wata recover tu. It's a normal debt. Whatever you owe the company is a normal debt to the company. The company can recover it at any time by selling any property that you have. It's like you having a loan to the bank. Okay? And you saying that, how will the bank come for me? The bank will come for you. They'll find a way. So yes, the liquidator or the administrator will give you a call. Like, my friend, Lipa, if you don't pay, then of course they will start looking for you. So if you are not able to pay because you're broke, again, that is another story. But they will first find ways to make you pay, including attaching your salary, including selling or auctioning even your house or even your car. So yes, kulipa, lazima utalipa. Tuko sawa?
Niko sawa, Jacktone. Thanks for that, Asante.
All right, it's a normal debt. It's a normal debt. So and remember that this only applies to original during allotment. The only time you can get shares on credit is during allotment. We have two things. We have allotment and transfer. Okay. When the company gives the shares for the very first time, those shares are allotted. When you're giving the shares for the very, very, very first time, those shares are allotted. After allotment, what normally happens is just the normal transfer. So at the initial allotment, that is where the company will say that because ni sisi tu tunaanza kampuni. Yeah? Business ni yetu. Ni sisi tunaanza. So tufanye hivi, ukichukua shares, lazima ulipe 50%. Hiyo 50% nyingine utalipa baadaye. That is only a privilege of the initial shareholders during allotment. But after that, you cannot buy the company shares on credit. So it is only a privilege of those initial members of the company, those that signed the memorandum of association. After that, kila mtu lazima ulipe yote. So at the end of the day, they will still come for you. They know you, they have your records, and the business is still yours. You are still a director or a shareholder in that company. So they will still know where you are and who you are and who your children are, who is your wife, who is your husband. They will know and they will come for you and you will pay. Debt collectors is something you can't avoid. All right, sawa. So is there any other question, guys? We started from general principles, advantages, types, registration, and the question of membership. All is good, all is fine. I'm just asking again. Two people to confirm.
Very much okay.
All right, fine.
Very
Sawa. So for purpose of the next class, please start reading on conversion of companies, resolutions and meetings, and directors. We'll discuss those in the next class. I will see you tomorrow for the most interesting discussion, that is conveyancing. Same time, same place. Conveyancing.